In today's class, we'll be discussing about technical analysis, which is another method of security analysis. So, what is technical analysis? Technical analysis is a method of trying to find out the trend of the movement of share prices by analyzing historical prices. That is, technical analysts will study the prices of the previous years in order to predict the prices of the future and then make a buy or sell decision. So let's see what is technical analysis in detail. See, technical analysts believe that share prices are determined by demand and supply forces which are operating in the market. That is, the price is determined by demand and supply forces. That means when the supply is less, that is when the shares of a particular company is less or securities of a particular industry is less, then the price will increase because there will be more demand than supply. And when that supply exceeds demand, the price will fall. So demand and supply forces are the ones which will help you to determine the share price. So the technical analyst concentrates on the movement of the share prices. They believe that the prices of shares moves in trends or waves. That is, it will follow a pattern or a direction during a particular time. It could be an upward trend or downward trend. If the prices are increasing for a constant period of time, then it shows a upward trend, and if the prices are falling, then it shows a downward trend. So what technical analysts believe is that the present trend is always influenced by the past trends. And by analyzing the past trends, we can predict the future trends. So simply saying, technical analysis is a study of past or historical price and volume movements so as to predict the future stock price behavior. That is what is technical analysis. They will study the past price with an intention to understand the future price movements and thereby make wise buy and sell decisions. They can wisely take decisions on whether to buy their securities or sell their securities. So what is Dow's theory? See, it was formulated by Charles H. Dow, and according to him, he said that stock prices do not move on a random basis. The prices are not moving randomly. Instead, they have three distinct cyclical trends that guide their direction. So there are three movements which are cyclical in nature that guides the direction of share prices. That is what is known as the Dow theory. Charles H. Dow is the person who formulated that particular theory. So according to him, there are three distinct cyclical trends. The first one is primary movement. See, when we chart out the prices of securities over a period of time, and when we analyze that chart, then we can see that the price is following a certain trend. That is, we have to chart out the prices of a number of years. We are studying the trend of a long period of time, then we can see that the price is either showing an upward trend or it's showing a downward trend. This long-term trend of the market, the overall trend of the market, the long-term trend is known as the primary movements. What is secondary reactions? The secondary reaction means, in contrast to the general movement in the market at present, there will be some movements, there will be some price movements which moves in the opposite direction. Suppose the price of a security is showing consistent increase over a period of time. That is, suppose the price was rupees 40 in the morning, the beginning price, the opening price was rupees 40, and after a few hours it became 50. Then again it became 60. Now if that is the condition, then it went back to 54 and came down to 45 and keeps on fluctuating throughout the day. Now those are known as minor movements. These minor movements are not helpful for us in studying the future price because these keeps changing or fluctuating frequently and we cannot really depend on these price changes to predict anything. The secondary reactions means over a period of time when we are studying the primary movements, we understood what is primary movements, right? The general trend in the market, the upward trend or the downward trend. So against that particular trend, if there's an opposite movement of the price, it is known as secondary reactions. Suppose it is showing an upward trend. We are studying the performance of share prices for 5 years. In the first year, the prices ranged between 40 to 50, and second year it became 50 to 60. Third year it's 60 to 70, and in between we can see that the prices will fall below this range. That is known as the secondary reactions. It lasts only for a short while and moves opposite to the primary movement. These are also known as corrections. So if the price is increasing, then after a certain period of time, there will be a short fall of price for a short period of time. That fall is known as a secondary reaction. Again, the price will increase. Again, after some time, it will fall short for a very small period of time. And that is known as secondary reaction. If it's a bearish trend, the price might be falling. Then after some time, the price will increase for a short period of time and again go back to a downward trend. This difference during that short period, the difference or the movement of the price in the opposite direction during that short period is known as secondary reactions. Minor movements are the day-to-day fluctuations in the market. So we again explaining the Dow's theory. He explained there are three types of movements, right? There's a primary movement, there's a secondary movement, and there are minor movements. And the most important one is primary movement. So how do we study the movement of prices? He said the easiest way is to chart it out in a line chart. You could just note down the closing price of securities in a chart. You can plot it in a chart and then identify the pattern. Now, among the three movements, primary movement is the most important one that will help you to predict the future prices. Now, primary trend is said to have three phases. And in between that each phase there is a secondary reaction. Let's see what are the three phases in the primary movement. So suppose it's a bullish trend. If it's showing a rise in price, the general movement in the market is an increase in price, then it is known as a bullish trend. So the first phase, the prices will be pushed up because of revival of confidence. People are confident that this security is going to perform well. So that's why they start buying that security. That is why it started generating demand, and when there is increased demand, the prices got pushed up. During the second phase, because there is demand for the securities of the particular company, the company was able to perform really well and they earned more profits than the previous year. So there's an improvement in the corporate earning. The company that you invested in has earned more profits. Then the belief or the trust of the investors increases and they will be willing to invest more in that particular company. So this leads to the second phase of increase in the share prices. Now in the third phase, due to inflation and speculation, there are speculators out there who believe that the price is going to increase further and they will create demand for the securities by still purchasing that securities at a high price. And because there is still demand, the prices will increase as predicted. So this is the third phase. So if it's a bullish trend, then there are three phases in the primary movement. If it's an upward trend, that is a bullish trend. If the prices are rising, during the first phase, there is revival of confidence and therefore the price increases. Then for a short period of time, the price will come down. That is known as a secondary reaction. And the second phase will start. During the second phase, the price is increasing because the company is earning better profits than in the past years. And again, at the end of the second phase, the price will fall for a short period of time, which is known as the correction or the secondary reaction. Again, the price will increase, which notes the beginning of the third phase. During this third phase, the price of the security is increasing because people believe that the prices will increase further. So there are still buyers for that security even at that high price, and therefore the price keeps moving upward. This is the three phases of the primary movement in the bullish trend. The bullish trend is shown through higher tops and higher bottoms. That you will understand only when I show the chart to you. I'll explain to you in the coming slides. The second one is bearish trend. Suppose the general trend in the market is downwards movement, that is the price is falling. In that case also there's a primary movement is downward, and there are three phases for this downward movement, the reasons why the prices start falling. Okay, the first phase begins when people give up hope, when people expect that the price of the security is going to fall, then they will sell off that security and try to get the money invested back. And when they sell the securities, the supply of that particular security in the market increases and the demand is falling. So in this case, the price will go down in the first phase. Now, towards the end of the first phase, the price will increase for a short period of time. That is, it will move in the opposite direction. And this is known as the secondary reactions or the corrections. Now, again, the second phase will begin when the price starts falling again. And during the second phase, the price falls because the company is not earning profits as expected and it's giving out lesser dividends than in the previous years. Then people are going to panic because their returns are getting reduced. The company is not performing well, so they will wish to sell off their securities and exit from that particular company's securities. So again, the price will fall because of low demand and increased supply. And at the end of the second phase, the price will increase for a very short period of time, which is known as a secondary reaction or the correction. And then the third phase will begin when the price starts falling again. And this is the period in which there is distress selling. Distress selling means the investors are they couldn't make a profit out of that investment and they are willing to sell off that security at whatever price is available in the market. They do not wish to hold it for a longer period of time and earn nothing out of it. They fear that the price is going to come down to nothing. So they are willing to sell it off at any low price. Even by suffering loss, they are willing to give up their securities and sell it off. So that is the third phase. So there are three phases, whether it's in the bullish trend or in the bearish trend. Now again, the Dow theory emphasizes on the volume of transaction also. Volume of transaction means how many people are buying or how many people are selling that particular security. What is the volume of transaction at a particular period? If there is high volume, then it will show a trend. That is what they believe. According to theory, volume would expand along the main trend. If the main trend is bullish, the volume should increase with the rise in prices and fall during the intermediate reactions. So they are saying that the volume of transactions will move as per the main trend. If the trend that is in the market right now is bullish, bullish means there's a rise in price going on. If it's a bullish trend, with each rise in price, the volume of transactions should also increase. And during the time of the secondary reaction, the volume will fall for a short period of time. It will go down. Now, if it's a bearish market means there's a fall in price. The prices are going down. So along with the fall of prices, the volume of transaction should also increase. And when there is a secondary reaction for a short period of time, that time the volume will also decrease. That is how they believe it to be. Now, don't misunderstand volume of transaction with just sales. It could be purchase also. So volume of transactions could be either because people are buying the securities as a bulk or they're selling it off. A lot of people decide to sell it off. That time also we say the volume has increased. So according to Dow's theory, the volume of transaction is taken into consideration. The volume of transaction will move along with the trend. If it's a bearish trend, then the volume will increase with when the price rises. If it's a bearish market, then the volume of sales will increase when the price falls. Now there are certain assumptions for this theory, which is also referred to as hypothesis. The first one is primary trend cannot be manipulated. They're saying that whatever is the primary trend in the market, whether it's an upward trend or a downward trend, it cannot be changed or influenced by the activities of an individual or a single firm or a group of people. What is the trend? That will persist no matter what your individual decision is. The second hypothesis is that average discounts everything. See, fundamental analysts, what did they do? They calculated the intrinsic value of the security, they compared it with the market price, and then there was a difference between the intrinsic value and the market price. And they made use of this difference to gain profits, right? They will make a buy or sell decision based upon the difference between the intrinsic value and the market price. But what technical analysts believe is that that is not possible at all times. Whatever price is reflected in the market is the intrinsic price, because the price is ruled by the demand and supply forces, and the demand and supply forces are made after taking into account all the factors that influence that particular security's price. So no one can gain anything by studying the intrinsic value, because at all points of time the intrinsic value and the market value is going to be the same, because the market information, the information is available to everyone in the market and everyone is going to make the similar decisions. That's what they believe. The third hypothesis, theory is not infallible. It means this theory is capable of errors. There is a chance that there might be errors in this hypothesis. So what is Dow's theory? It is one of the important theories in technical analysis. It was developed by Charles H. Dow. According to him, there are three distinct movements, cyclical movements of price. The first one is a primary movement, which shows the trend of the general market, the long-term trend in the market. The second is secondary reactions, that is a short-term corrections in the general trend. It moves opposite to the primary movements. The third is minor movements, that is the day-to-day fluctuations in the share price. Now what's most important is the primary movements. Now the primary movements takes place in three phases, whether it's a bearish market or a bullish market. And we saw the three phases. Then they believed that volume of transaction is also important. The volume will move as per the trend. If it's a bearish market, the volume of transaction will increase with each decrease in price. If it's a bullish market, the volume of transaction will increase with each rise in price. Now, there are also three assumptions regarding this theory. The first is that the primary trend cannot be influenced by any single individual or any single group of people. And the second hypothesis is that the average discounts everything. That is, the market information is available to everyone and the price is arrived after taking into consideration all the factors that affect that particular price. So the intrinsic value and the market value is going to be the same always. Third is that theory is not infallible. That is, there is a probability that there might be errors in this theory. Now, what are the principles of technical analysis? The next topic. See, the market value of security is related to the demand and supply factors operating in the market. Now, there are both rational and irrational factors which surround the supply and demand factors of a security. People might take decisions based on rational factors, and there might be irrational factors also, like some of the people believe that the securities price is going to fall without any basis for that belief. But still, when a lot of people start believing like that, they will act on their belief, and eventually what they believe will become the reality. So there are irrational factors also which surround the supply and demand factors of a security. Now, another principle of technical analysis is that the prices move in such a way that they will follow a particular direction for some period of time. That is, if the direction is upwards, then the prices are going to go up for some period of time and then only change. And if the trend is downwards, that is the direction of the price movement is downwards, the prices keep falling for some period of time before it changes. So the stock prices will follow a particular direction for some period of time. And the stock prices changes with a change in the demand and supply factors. Now, how do we study the demand and supply changes? That is studied through analysis of charts. We'll prepare various charts based upon the closing price, opening price, the highest price, the lowest price of the day, and then we'll chart it out in a chart and then decide the changes that is going to take place in the share prices. Now, these recorded price movements are used by the analyst to forecast the future prices. So these are the principles of technical analysis. I said in order to study the price movements, we draw a lot of charts, right? So how are charts drawn? Charts are drawn by by showing the prices in the y-axis and the date in the x-axis. Now we take into account the closing price, which is the last price of the day, the price at which the security came to, and that is, suppose you are trading in a particular security. When you start trading in the morning, the first price is known as the opening price. Then that price will keep on fluctuating till 3 o'clock or 3:30 till the trading time is over. So the price when the trading time was over is known as the closing price. The beginning price is known as the opening price. The closing price, the price at the end of the day. The high is the highest price of the day and low is the lowest price of the day. So these four prices are considered for drawing charts. Now some examples of charts are, first one is line chart. So in a line chart, closing prices are taken into consideration. The closing price for each day is recorded. Here the months are taken. It can be years, months, days, whatever it is, you can take in the x-axis. The price is always shown in the y-axis. So in case of a line chart, the closing prices are recorded using some dots, and these dots are connected using lines. And then we'll study the pattern of that line chart to understand whether it's an upward trend or downward trend and make a buy or sell decision accordingly. So first type of chart is line charts which use closing price. Second category is bar chart. Okay, the first figure is the example of bar charts. This is how it looks. The second figure is the explanation of what it is. See, we take into consideration four prices to draw a bar chart. On Monday, we'll record the highest price of the day. The lowest price is also recorded, and then we'll draw a straight line connecting the highest price and the lowest price. Now the closing price is shown in the right side as a horizontal line, and the opening price is shown on the left side as a horizontal line. So this is what that figure means. So each day we are going to draw the price bar chart and understand the highs and lows of the particular day and see whether the opening was higher than the closing price or the closing price was higher than the opening price. So if the opening price is higher than the closing price means, when we started trading, imagine the price of the security was 70 rupees. But at the end of the day, it came to rupees 68. Then it means the opening price is higher than the closing price. That means the price fell down during that day. So it's showing a bearish trend. Now suppose the closing price is higher than the opening price. The price increased at the end of the day. It was trading for rupees 50. By the end of the day, it reached to 55. Then it is showing a bullish trend. So this is how we analyze a price bar chart. The third type of chart is Japanese candlestick. In the Japanese candlestick chart also, we'll take into consideration all four prices. The highest price and lowest price is recorded, and we draw a vertical line connecting both of that. Then we'll record the opening price and the closing price, and this is shown as a rectangle box. Now, if the opening price is higher than the closing price, and that is the indication of a bearish market, and then it is denoted by a black candlestick. That is, that small rectangle in between that closing price and the opening price will be completely filled in a black shade as shown in the second figure, and this is known as a black candlestick. Now suppose it's a bullish trend that is going on in the market and the closing price is higher than the opening price, then the triangle will be filled with white color, and that is known as a white candlestick. Now there's also a doji candlestick, D-O-J-I, which is not shown anywhere in this figure. In case of a doji candlestick, the opening price and the closing price will be the same. In that case, the figure will look like see, there's a high price and the low price, and there'll be a vertical line, and there'll be a horizontal line somewhere between that shows the opening and the closing price. Both are the same. So in the doji candlestick, there will not be any rectangle. There will only be a small horizontal line. See, there's one in this left-hand chart. The fourth one. See the fourth line? See, there's a line and there's a small rectangle there. But in case of a doji candlestick, there will only be a single line here. There will not be any colors filling that line. So each day's high, low, closing and opening prices are recorded, and then we'll study the trend of the price movements. So this is another example of a chart, price chart. So there are trends and trend reversals. I said we'll record the prices in a chart and we'll analyze the trend. So what is a trend? Trend is the direction of movement of share prices in the market. In what direction is the share prices moving? That is known as the trend. When the price is moving upwards, it is showing a rising trend. That means there will be higher bottoms and higher tops. And when the price is moving downwards, it's showing a falling trend, which means there will be lower bottoms and lower tops. Now, when there's a change in the direction of the trend which is being currently followed, then it is known as trend reversal. Suppose the market was following an upward trend and suddenly there is a fall in price for a period of time. It is showing a trend reversal. When the trend reverses, and the prices start to rise, the analyst will recommend that you buy that particular share, because till now it was showing a downward trend. Now it's showing a rise in the prices. So it's best to buy that share and keep it with you, because the price will increase further and you can sell off that security at a higher price. Now suppose the trend begins to fall. Till now the security had a good price and the security price is going down. There's a trend reversal, so it's going down, and they will recommend you to sell that security, because if you hold it for any longer, then you're going to earn a loss by holding that security. Now during a flat trend, that is, the market is not showing any sort of a trend, then the analyst will ask you to stay away from the market and do nothing. No need to buy anything or sell anything. We just wait it out till a trend forms. So these are known as trends and trend reversals. Now the different chart patterns. The first is the support and resistance. See, these are all, looking into this chart, we can see a lot of lines here. See, these all show the prices, right? The prices are recorded and then just connected using lines. This is the line chart. And here, there is this particular price, and the price will not fall below that level. Suppose the price here is rupees 50. The price keeps fluctuating. It goes up to 60, then again it comes down to 50, then it goes up to 54, then it falls down to 53, then it goes up to 57, falls down to 56, goes up to 60 again, then it falls to 50. So we can see that no matter how much the prices are fluctuating, there is this common price at which the price will come down to and then increase. Now that price or that level is known as the support line. When we draw all that low points together, we'll get a common price, which is the support line. So we can assume that the price will not fall below that level. Now, even when the price is increasing, there is this level at the top where the price reaches and then falls down. Again, it reaches that particular level and again it comes down. So we can call that particular line as the resistance line by connecting the top portions together. That's the resistance line. Now, suppose the price moves and breaks that resistance line. The next high is above the resistance line. Then this resistance line will form the new support line. Okay, once the price has increased more than the resistance, that is, once the price has gone up than the earlier resistance line, then that resistance line will now act as a support line. That is, the price, suppose the resistance was 60, the next price was 64, then the price will come down to 60, it will go to 70, it is 74, 76, it came down to 60 again, and again it went up to 70, came down to 60 again, then 64, 68, then it went up to 74 or something. So in that case, we can see that once the resistance is cut, the resistance line will start acting as the support line. Now for here, in this particular part, 60 is the support line. That with this, when we analyze the securities, we share that every time the price comes down to 60, it starts rising again. Again, it comes down to 60, it starts rising again. So once the resistance line is cut, it will start acting as the next support line. Now, what would have been the situation if the support line was cut? That is not here in this chart. I'm just asking you to imagine if the support line is cut and the price falls below. I said here, suppose it's a 50 is the price. The price went down to 44 or 45. Okay, so that means the support line was cut and the price went below than the 50 rupees, which we set as the support line. In that case, the support will now act as the resistance. When the price starts fluctuating, then it will come up to 50 and will go down again. Again, it will come up to 50, it will go down again. So that support line will now start acting as the resistance line. Now, how do we make decisions based upon this resistance support lines? Once the resistance line is cut, it shows a trend reversal. And once the support line is cut, it also shows a trend reversal. If the resistance line is cut, it means a bullish phase is going to follow, that is the price is going to increase. If the support line is cut, it means a bearish phase is going to follow and the prices are going to fall. So then we'll make a buy or sell decision by considering this support and resistance lines. Next is reversal patterns. That shows when this pattern occurs, whatever was the trend that was in the market right now will be reversed. So that is an indication of reversal of trend when this patterns form. The first example is head and shoulder formation. See, in this formation, see every peak is known as a top and every bottom price is known as the bottom. So that is why we said earlier that the bearish trend is denoted by lower tops and lower bottoms. That is, see in this case, this top, this is another top. So the second top is lower than the first top. The same way, this is one bottom. See, this is the second bottom. The second bottom is lower than the first bottom. So the bearish trend denotes lower tops and lower bottoms. This is the same in case of, the opposite is same in the case of a bullish trend. In that case, the second top will be higher than the first top and the second bottom will also be higher than the first bottom. So it shows a bullish phase. Now let it be. Let's come back to what is head and shoulder formation. In head and shoulder formation, there is a increase in price. It came down. Then again, more increase is there in the second phase. That is, the price rises above than the previous level. That is the head. Then again falls. Then there is an increase in the price, but not as much as a second increase in the price. This is a right shoulder. So this is considered as a left shoulder, the head and the right shoulder. Now, when there is this type of a formation, head and shoulder formation, it denotes the end of a bullish phase and a trend reversal is going to take place. The price is going to fall now. That is what the head and shoulder formation indicates. Suppose it's an inverse head and shoulder formation as shown in the second image in the slide. It is an indication of the end of a bearish trend. When a head and shoulder formation, an inverted head and shoulder formation takes place, it shows that the prices are going to increase now. It is going to rise now. It denotes the beginning of a bullish trend, the end of a bearish trend. So the head and shoulder formation shows the end of a bullish trend and the beginning of a bearish trend, whereas the inverse head and shoulder formation shows the end of a bearish trend and the beginning of a bullish trend. These are trend reversal patterns. That is, when this pattern comes up, it means whatever trend was going on in the market is going to reverse. That is, trend reversal will take place. If it was bullish, it's going to become bearish. If it was bearish, it's going to become bullish. Now, there are some continuation patterns. In the case of continuation patterns, it is a period of indecision. The trend has not yet taken place. We don't know whether it's going to be a bullish phase or a bearish phase. For some period of time, the price is going to just keep on fluctuating without any uncertainty. And during these times, continuation patterns are formed. And during this phase, the investor will wait it out without making any particular decision as to buy or sell. There are three types of patterns: as a triangle, there's a pennant, and there are flags. In triangle, when we join the tops and bottoms together, we might get an ascending triangle in case of a bullish market. We might get a descending triangle in case of a bearish market, and we can also get a symmetrical triangle. Now, pennants are similar to symmetrical triangles. So, what is the difference between a triangle and a pennant? Pennant is for a short period of time, whereas triangles takes into account the change in price for a number of years. This could be for 2 weeks or a few number of days. The pennant is taken into consideration, but triangle is calculated for a long period of time. There is a major difference between a triangle and a pennant. Now, what are flags? Flags will give when we join the tops and bottoms together, it will give a parallelogram shape. So if it's an upward trend, it will show like this. If it's a downward trend, once the trend breaks out from that parallelogram, it will show which trend is going to follow. So these are three patterns, continuation patterns. The last topic for today's class is Elliott wave theory. So what is Elliott wave theory? So it was formulated in 1934 by Ralph Elliott. He analyzed 75 years of stock price movements and charts before he formulated this theory. So according to this theory, the market moves in waves. So what's a wave? It is a movement of the market price, one change in direction to the next change in the same direction. So if the price is moving in a particular direction, that is one wave. When the direction changes, it becomes a second wave. Again, it moves in a certain direction, that is the third wave. So that is how the price moves according to Ralph Elliott. A movement in a particular direction can be represented by 5 distinct waves. He says that if it's showing an upward trend, it is going to move in 5 distinct waves. If it's a downward trend also, it's going to move in 5 distinct waves before it makes a change. So out of these 5 waves, 3 waves are in the direction of the primary movement, and it is termed as the impulse waves. And 2 waves are against the direction of the primary movement, and these are known as the corrective waves or reaction waves. You can understand that better when we look into the chart. See, in this case, price increased. This is the first wave. That is an impulse wave. Then the price fell down. That is, it's moving in the opposite direction. So this is wave 2, and the price fell down. So this is a correction wave. Again, the price increased. So it's an impulse wave. This is about wave 3. The price fell down. This is a correction wave. Again, the price increased. This is an impulse wave. So according to Elliott wave, there are 5 waves in every direction. If it's in the upward direction also, or whether it's in downward direction also, there will always be 5 waves. And 3 of the waves are impulse waves because they move in the same direction as the general trend. Here the trend is upward moving. So 3 of the waves move in the general trend of the market. 2 of the waves move opposite to the primary movements. This is wave 2 and wave 4. These are known as the correction waves. Corrective waves, sorry. Corrective waves are also called reaction waves. Now, after the 5th wave, the 3 waves will be there, which we'll denote as wave A, wave B, and wave C. At the end of wave C, it denotes a trend reversal. Whatever trend was being followed will be reversed, and the opposite trend will be followed. See, it is very confusing if we look into the charts and try to find out the waves. Okay, so there are a set of rules for determining whether this is a valid Elliott wave theory or not. So according to the rules, wave 2 cannot come down to more than 100% of wave 1. See, the wave, there was an increase in the first case, and there's a decrease, but the decrease is not at the same level as the increase. So one of the rules is that wave 2 cannot fall below the starting price of wave 1. Another rule is that, see, in wave 3, this wave 3 should not be the shortest wave when we look in wave 1 and wave 5. There are 3 impulse waves, wave 1, wave 3, and wave 5. In that, wave 3 should not be the shortest wave. If that is the case, then we cannot count that as a wave. Now, wave A means it will fall. The price will fall more than the fall of price in wave 4. See, when the wave 4 came, when that correction came, price fell down to a certain limit. But when wave A came, that price should be bigger than the correction made by wave 4. Same is the case with wave C. So when the price falls more than the corrections in the previous two cases, we know that the wave has come to an end and a new trend is setting. So the last three will be marked as wave A, wave B, and wave C, and then the trend reversal will take place. This is what Elliott Wave says in his theory. I hope this much is clear. In the next class, we'll discuss the market indicators, the mathematical indicators which are used to study the trends of individual securities, and we'll also see what is efficient market hypothesis. Thank you.